All right, ladies and gentlemen, welcome to the Wednesday morning webinar. We appreciate everybody being on here this morning. We have a very special guest with us. Tim Swoboda is joining us from Silac. And Tim, how long have you been with Silac now?
Just over 2 years now.
Very nice. Okay. Tim is a great guy. Every time I get to hang out with him, there's people that you have to do business with and you're nice to. Tim's not one of those guys. I have to do business with him, but he's fun to be nice to as well. So I don't know why I said all that. Maddie can edit all that out. But I appreciate the friendship that Tim has given us and just the help he's given us. And I can't wait for you guys to hear him talk about something that he's very passionate about. And so, Tim, take it away, buddy. And like I said, guys, just put your chats, make sure we're muted and put your chats down there or your questions in the chat box and Tim will get to them. So
perfect. Can you all see my screen okay? Is that good?
Yes, sir.
Awesome. Well, good morning, everybody. Thank you for taking some time out of your Wednesday to join me today. I know I got the pleasure to meet some of you at the Springfield conference. All I'm going to say is, Dallas, I hope you guys do a better conference next year and no rain. It just happens to rain every day in Springfield, it seems like, but it was a great event. I enjoyed getting to meet a lot of you there. And we're going to go over some products with Silac to kind of really get everybody's interest going and show you the simplistic nature of really how easy it is to do business on the annuity side. So I want to wipe out any fears people may have and kind of just go over how simple these products are designed so your clients can truly understand the benefits of these annuity contracts. So with that, here's what we're going to cover. I want to cover who Silac is. If Silac is new to you, we're going to go over a brief background of Silac. We're going to go over some product highlights. Then we're going to touch on two of our proprietary indexes that we have. Nobody else has them except for us. And then we're also going to highlight some positioning and case studies on a few of the products. Now, we can go into much more detail later, but this is to give you a lot of information about our products first before we can dive in. I know I have a limited amount of time, so I don't want to take advantage of that, but we will get into some of those positioning and case studies. So here we are. Silac was formerly known as Equitable. It was founded back in 1935. Fast forward a bunch of years, we were acquired by our parent company also named Silac. And in 2017, we decided to change focus. Before, what Equitable or Silac did was we were focused on med sup, long-term care, and final expense. We decided to change that. We said, look, we're going to stop doing this and we're going to turn over to annuities. And in 2018, we launched our very first MIGA line, which is a multi-year guarantee annuity. And in 2019, we launched our very first index annuity and we brought on our first proprietary index with Barclays, which was with Atlas. In 2020, we kept growing. We launched our second index annuity with Denali, which we're going to talk about, which is probably our hottest annuity out there. And in 2020, we joined forces with Credit Suisse, bringing on the Raven Pack proprietary index. And in 2022, all right, we launched our newest annuity called Vega. So there's the history of Silac. We are really fairly new to the annuity space, but as you can see, we are growing. All right, and we're growing because of great partnerships, especially with partners. So that's how we're focused on our history there. Now, the first product I want to jump into, probably one of the easiest annuities. This is the best transition to get people out of bonds or maybe those CDs, right? CDs, they stand for certificate of depreciation. No, I'm just kidding. But with a low yield on CDs, a lot of people are looking at some higher form of returns that are guaranteed. Here comes our MIGA line. On our MIGA line, we have two chassis. We have a 2-year and a 5-year version. It can go up to age 90. That is a big deal, okay? A lot of annuities stop at age 80 or 85. What you're going to see throughout this presentation is we have annuities that go up to age 90. Now, we do have some liquid options and some non-liquid options, which we can add liquidity to, but our rates are extremely competitive. We have started the summer off with some hot sizzling rates by increasing these rates over time. Here's where we got effective June 1st. These rates are only days old. On the left, you have the secure savings side, okay? That is the fully loaded MIGA line with all the liquidity built in. full account value and spousal continuation at death, but take a look at the 2-year rate. A guaranteed 2 years, 2.35. And if the client wants a 5-year, 3.25. Those rates are guaranteed for that term. After that term, the client can continue it, whatever the current rate might be, or they can walk away and move the money elsewhere. Now, the Secure Savings Elite side, what you're going to notice is the rates are, a little bit higher. They are a little bit higher because what we did was we pulled those free withdrawals out of the contract. We realized that some people just want the highest rate. They're not going to touch any of that money. So we said, well, what if we could take all of that liquidity out, but they can still add it back in at a rate reduction? Let's say a client doesn't need the 5% or the accumulated interest. All they want to do is they take their RMD. Well, if you look on the bottom of your screen there, they can add in all of them, one of them, or none of them at a rate reduction. Okay. So they can truly get the highest rate possible without any liquidity, or they can kind of pick and choose, or what I would like to call it is a build-a-bear option. They can stuff it as fat as they want, or they can keep it skinny and get a higher rate. Now, the big difference on the Secure Savings and the Secure Savings Elite side, pay close attention to this. It is cash value at death. Okay. So really, the Secure Savings Elite side, in my opinion, is probably not geared for the older clients, but some of those clients that are younger looking to reposition some of those bonds or maybe even the CDs to get that highest growth effect on the MYGA line. So pretty simple story on the MYGA, nothing too exciting, just a great way to reposition some assets and secure an awesome rate of return for those clients. Now, which brings us to our first index annuity that I mentioned before, called our Teton series. So Teton, this is accumulation focused. We have a 7, 10, and 14-year version. All right. As I mentioned before, our 7-year contract does go up to age 90. And what's special about this contract is our cumulative withdrawal feature. Now, how the cumulative withdrawal feature works is if the client doesn't take any form of withdrawals, including RMDs, all right, that free withdrawal will accumulate up to a maximum of 30%. Now, the normal free withdrawal is 5% after the first year. Okay. So after 6 years, if they haven't touched any of that, they could take out a 30% free withdrawal, which could lead to a big chunk of change, depending upon what their account value could grow to. And again, you're going to hear this time and time throughout this presentation. None of our index annuities have any type of fees associated with it. So there's no charge for that cumulative withdrawal feature. All right. That is built into the contract. Now, here are the basics. As I said before, our 7-year contract goes up to age 90 on our Teton. Max issue age for our 10-year contract is age 85, and our 14-year is age 80. The minimum premium to start our contracts, including our MYGA, is $10,000. However, on our index annuity line, we allow for additional premiums to be added to the contract in the first 12 months. That additional premium minimum requirement is $2,000. And max premium is $1 million. Now, for any big hitters out there, we do accept large cases all the time. We have to get home office approval, but don't be afraid. We accept those quite frequently. I just had 2 of them go through, one for 2.6 and one for 4.8. So we do accept those large cases. We just have to know ahead of time. But those are the basics for the Teton series. Things going on Wednesday. Here are those caps and rates. And if you're unfamiliar with some caps and rates, these are very competitive. Take a look at our fixed rate, 2.25 on a 7-year contract, 2.75 on the 14. But look at the annual point-to-point with cap. We are just below 6% on a 7-year contract. That is a big, big deal. And if you look on the very bottom, you're going to see our proprietary indices, our Atlas at 120 on our 7, 125 for the Raven Pack, capping out at 130% on the Teton 14. Now, we do something a little bit different with Silac. All right. As you can see on the Atlas and Raven Pack strategy, we have what's called the annual point-to-point spread or boost. Well, if the option budget allows for it, we don't have to have a spread. We can actually add what's called a boost. And how this works is, let's assume the client was in the Teton 7 contract and they allocated some of their funds to the Atlas annual point-to-point with boost, which is 1%. Let's say the Atlas strategy did 5 plus that 1%, the client walks away with a 6% interest credit. Now let's assume the index didn't do that well, okay? And let's assume the Atlas strategy did a negative 50 basis points. Well, we can take that positive 1, subtract that downturn that the Atlas had that year, and the client would still walk away with a positive interest credit of 50 basis points. So that boost strategy can take a bad year and could turn it into a slightly positive good year with some interest credits. So it's definitely something you want to pay attention to. I can't tell you which one's the best because I can't tell you what the future is going to hold, but there's definitely opportunity for accumulation. Now on our bonus side, all right, there are the bonuses on your screen there. We cap out at a 10% bonus on the 14, 8 on the 10. Pay close attention on the 7-year contract. That is the contract that is age banded, so 0 to 80. The client's going to get a 6% bonus, and 81 to 90. That bonus is going to go down to 3.5. Now on the bonus side of the contract, the caps and rates are a little bit smaller, okay, as you can see on your screen here. Why is that? Well, that's because of the bonus that we're giving the client to jumpstart their contract. But there they are. Those rates are effective June 1st. But that's the Teton story. Great for accumulation. Very simple. The client puts money in. They can allocate however they want to allocate to show that accumulation potential. And then if they don't take any withdrawals, they have that unique cumulative withdrawal feature, which caps out at 30%. Pretty simple story. All right. But now we're going to change gears and focus on our newest, our leadership product called the Denali. Now, Denali is, as I said before, is capturing the most attention out there. And you're going to see why in just a few minutes. But let's understand the highlights here. So Denali is focused not only on accumulation, but it's also focused on lifetime income. Again, we still have the 7, 10, and 14-year chassis. We have the bonus and non-bonus version. As I said before, it does have an income component. So Denali can provide your clients with lifetime income. It also has wellness withdrawals. And again, since there are no fees on Silac annuities, there is no charge for these features on this contract. This is a big, big deal. Looking for an income rider product without a fee, Denali is your play. Now, here are the basics. All right. 7-year contract, as you saw before, goes up to age 90, 10-year age 85, 14 age 80. Before anybody can ask any questions, Tim, does the income rider go to the max issue age of 90? The answer is yes. What about that wellness withdrawal benefit? Does it go up to age 90? The answer is yes. So those are included, all right, up to the max issue age of each product. Now, the minimum premium, as you saw before, is $10,000. We still allow for additional premiums in our Denali contract for the first 12 months, and the basics are pretty much the same as you saw with Teton. Now, getting to the rates on Denali are a little bit higher than Teton, all right? 275 on the 7, 325 on the 14. Look at the annual point-to-point with cap, 6.5, 7% on the 14, and take a look at Atlas and rate. High of 145 on Atlas and 155% par rate on the Raven Pack strategy. Now, you might think that is a huge par rate. Tim, there has to be something weird about that. That must be a 2-year strategy. The answer is no. All of our strategies are 1-year strategies. So that is a big opportunity. So a client doesn't have to wait 2 years to see if they have earned any interest or not. All of our indexing strategies are built on a 1-year chassis, which is a big, big deal, especially when you're looking at par rates that high. Now, on our bonus side, on Denali, all of our bonuses are age banded, as you can see on the top of your screen. We still offer that lovely 10% bonus on the 14. It goes down to 5 at the older issue ages, a 5% bonus on the Denali bonus 7, and goes down to 2.5, 81 to 90. As you saw before with Teton, yes, the caps and rates are slightly lower. That's because we are offering that jump start of that bonus to the contract. Now, as I mentioned before, Denali has a lifetime withdrawal feature. How this works, all right, is everything is based on the account value of the contract, which keeps things super simple so the client can understand that their money or their benefits are real all the time. There is no phantom account that's growing. There's no fake money in this contract. Everything is geared to the account value. Since everything is geared to the account value, it allows Denali to not have restrictions such as that maximum roll-up term or benefit caps. Now, what we do have is we do have a 1-year wait before a client can activate income, okay? But more importantly, there's a term that if you've sold income rider products or any type of income story, this term called step up. I can tell you very rarely do you see step up in contracts, but on Denali, because of its simplistic form and everything based on the account value, step up is real. Now, what step up is, step up actually can allow the contract to grow after lifetime withdrawals begin to create a higher income automatically. So if a client starts income 5 years from now or 6 years from now or whenever, and they receive a huge interest credit, or it doesn't even have to be huge, or an interest credit that exceeds the withdrawal that came out, the account value grows and forces the higher income to be paid out that very next year. It happens automatically, and it can definitely happen by looking at some of those very competitive and high caps and rates we just saw. So there is definitely a big opportunity for step up to occur on this contract. And again, there is no charge for this feature whatsoever. Now, how does the lifetime withdrawal work? As I mentioned before, everything is based on the account value. So this is how it works. The math is pretty simple, okay? So we take the account value, we multiply it by the appropriate lifetime withdrawal percentage. It's pretty simple. On our highlight sheet, which you can get from our agent portal and also from our microsite, at every age, whether it's a single or joint payout, there's going to be a payout percentage that's assigned to that age when the client turns on income. So you take whatever the account value is, times that by the appropriate payout percentage, and that's how the lifetime withdrawal is going to be calculated. Now, you don't have to worry about calculating this yourself. Our software on our agent portal does it for you. But I want everybody to understand that's how the lifetime withdrawal works. So going into our last product, all right, this is our newest product. We're very excited to bring this to the table, is our Vega product. Now with Vega is focused on accumulation, but it's more focused on what we're going to look at in just a few minutes is a benefit value. So on the account value side, Vega does everything that Teton and Denali does, all right? Still has all those strategies, still has the same max issue ages of 90 on the 7, 85 on the 10, and 80 on the 14. And again, there are no fees associated with the Vega contract, all right? But let's understand how the Vega contract is really built. So we're going back to the basics here. On the Vega line, all right, on your account value, this is where the client's premium is going to be held and any interest credits that the client earns, which is where these free withdrawals come from. If the client wants to exit the contract, RMDs, the health riders, or if the client dies, the beneficiary can access the account value as a lump sum death benefit. But what's new on Vega is we added what's called a benefit value. And the benefit value not only takes the premium, but it applies any type of benefit bonus if the client's going into the bonus contract, and a multiplier of interest credits, which is where all of these features come into play. This is what's going to be geared towards the increasing lifetime withdrawals if it's elected, or level, or accelerated. All right, there are 3 forms of lifetime withdrawals available on our Vega line, not to mention the wellness withdrawals that's available on Denali is available on the increasing and level. But we also offer flexibility to the beneficiary, which is an enhanced death benefit that is that can be pulled from the benefit value for those beneficiaries. Now, what we did, this is new, okay? We have increased the bonus across the board, all right, to 35%. No, your eyes are not playing tricks on you. That is a 35% bonus on our 7, 10, and 14 year. Now, the bonus is different from Teton and Denali. The bonus on Vega goes into the benefit value. It is not a real account value bonus. And we're going to look at an example of where that bonus goes in. But the multipliers also come into play. Okay. And we're going to talk about how the multipliers work in just a little bit. But the multipliers for the 7 are 150, 175, and 200. Those multipliers come into play by how the interest credits work on the account value and applied to the actual benefit value. Now, here's how really it works. As you can see on your screen here, this is a simple illustration for the Vega Bonus 14. If you look at issue, the client puts in $100,000. Remember, our bonus is a 35% bonus. It doesn't go to the account value, but the client will see that in their benefit value. But take a look at these interest credits, okay? On year one, let's assume the account value performed at a received a 4% interest credit. Remember from that previous screen, that multiplier was 200%. So we apply a 200% times that 4% interest credit so the benefit value receives that 8% interest credit. That's how the multiplier works. Not only is the account value growing, but the benefit value is growing by how the account value performs and added by that multiplier, which can lead to some tremendous growth. If we look at the annual effective rate on the benefit rate alone, it's just under 7.5%. We apply that 35% bonus, just taking all the interest rates plus the multiplier. You're looking at an effective rate on a raw benefit value on the bonus contract of almost 11%. So a pretty big deal. So if your client's interested in a jump start, the bonus can definitely help. All right. But we do have a story where we said, well, what if we don't need the bonus? All right. We realize some clients want the maximum accumulation potential over the longevity of time, right? They don't want the bonus. Well, we have those options available on a non-bonus chassis. So we took that bonus out and we pumped up what's called the deferral multiplier. So on the 7-year contract, a 250%. So what does deferral mean? Deferral means as if the contract is not in payout mode, meaning they have not triggered lifetime income, these are what the multipliers are going to be. 300% on the 14-year contract. Now, once the client turns on income, the multipliers are going to change over to the payout multipliers that you see on the bottom, which were what we saw earlier. How do these multipliers work? Again, I want to drive this point home. Let's assume that the account value had a 4% interest rate credit and the client was in the Vega 14. We take that 4%, multiply it, since we're in deferral mode, by 300. The benefit value is going to see a 12% interest credit adjustment. All right. So those benefit multipliers can lead to a lot of accumulation in that benefit value, which can lead to some awesome income opportunities later in the contract. Now, here's how it really works on the bonus. I want to go through this one more time. Let's assume year one was 5%. We're still in deferral, almost a 15% benefit rate. There's some rounding behind the scenes. That's why it doesn't come out the same, but we keep going. Let's assume that there's an 8% interest credit, times that by 300. Your eyes are seeing everything real on the screen, 24.27% going into the benefit rate. But take a look at this year. There might be some years where the account value doesn't perform based upon the accumulation story. The best part about Silac, we don't have fees. So 300 times 0 is just a 0. Your account value doesn't go backwards. That's the story of these FIAs and with the Vega opportunity. Now, switching gears here, I want to explain the different forms of withdrawals to everybody. Our first withdrawal option, which we believe is probably the most competitive option out there, is the increasing lifetime withdrawal. Just like the name says, the income can increase or will increase based upon not only account value performance, but also by the multiplier. Now, the increasing lifetime withdrawals do start out a little bit lower than level, all right? But because of the power of the multipliers, it can catch up. The wellness withdrawal is also available. I want to point out on the Vega contract, there is a little bit of a longer wait period. All right. So this contract is not for those that want to start income 2 years from now, 3 years from now. There is a longer waiting period. So on the Vega 7, there's a 7-year wait. And on the 10 and 14, there's a 10-year wait before a client can activate income. Now going to level, this is our highest payout percentage. Excuse me. Just like before, the same waiting periods do apply. And accelerated. Accelerated is the first of its kind with Vega. There is no other contract out there that has this type of benefit. And what we did was we said, let's add this benefit to the Vega contract. Okay. The waiting periods is still the same, but it's for those clients that say, hey, I want the most amount of income possible in the least amount of time. How can I get that benefit value out? Well, with accelerated withdrawals on the non-bonus chassis, after the client has satisfied the waiting period, they can take out that benefit value over a 10-year period. After 10 years, the contract is done. And on the bonus chassis, it's a 15-year payout. And of course, the enhanced death benefit. Excuse me. So the enhanced death benefit allows the beneficiaries, if the client dies, to access the benefit value and pay that out over 5 years. So the beneficiaries have a ton of flexibility as well. They can choose to take whatever the remaining account value is and pay it out over as a lump sum, or they can take the benefit value and they can receive the benefit value as a death benefit, which is paid out to them over a 5-year period. So Dallas, I want to stop here and see if there's any questions on our products before I get into our proprietary indices, if you don't mind. All right. I take silence as a good thing. So let's kind of go into our proprietary indices. Again, nobody else has these types of indices. Only Silac has these, which are on our Teton, Denali, and also our Vega contract line. So the first one I want to talk about is our Barclays Atlas Index. This was the very first one that we joined forces with, which has seen some incredible growth opportunities over the years. Now with Atlas, okay, this is a global index. So it is not only stuck in the S&P 500, but it looks at 11 different types of equities and bonds, okay, as you can see on your screen there. Now, one thing about the Atlas Index is a volatility control index. It has a 5% target volatility. And it always has to remain in that 5% target volatility or below which one or multiple segments or equities or bonds it can go in for that day. Now, what's cool about Atlas is Atlas has the ability to rebalance itself daily. There are not a lot of indices out there that can rebalance itself daily. Usually they're quarterly or semi-annual, whatever it may be. Atlas can rebalance itself daily. And it does this not only on what's called the optimal allocation, but it also looks at trending data. Now, trending data is really kind of cool because I'm going to be honest with you all, I didn't do that great in physics class, but I do know that if a ball rolls downhill, it's going to keep going until something stops it, right? Well, with trending data, all right, it looks at which one or some of those different types of components have a trend in it. to ride that trend to maximize its performance before it says, hey, that trend is no longer good. We need to jump off and find a new trend. So it looks at that trending data to help with the daily rebalancing. Now, again, as I mentioned before in our rate sheet, it has all 1-year strategies associated with it. So the client is going to receive an interest credit at the end of each year. There are no fees for the Atlas. And because of its target volatility, it allows for consistent renewal rates. So those rates, a lot of people say, oh, they're just good the first year, they're going to drop the second year. No, we have pieces on our agent portal that support our consistent renewal story along with our level option budget, which allows us to provide those consistent renewals on not only Atlas, but a number of our different indexing strategies. Now, Atlas is a newer index, okay? It hasn't been around for 10 years yet. So because it hasn't been around for 10 years, there are some states where it can't be illustrated in, but that doesn't mean the client can't elect to be in that. So the index is available wherever the product is available. It just can't be illustrated in some of those states. Now, if you want more information, we have a ton of information on our agent portal. There's a ton of information on our microsite, which we can send you, or you can actually go to the Barclays website itself and see how the index is performing, where it's allocated, what it's doing, and actually see back-tested data of how it's performed throughout the years. Now, RavenPack. RavenPack is one of my favorite indexes. I love the RavenPack story. RavenPack is really unique because RavenPack looks at the S&P 500. And it looks at the S&P 500 and it looks at all of the different companies and puts all of the companies into their appropriate sector. There are 11 sectors in the S&P 500. Now, what RavenPack or Credit Suisse RavenPack AI does is when it's looking at these different companies of the S&P 500, it says, I want to know the company's sentiment score or sentiment value. And a lot of people say, well, what is sentiment? Well, sentiment in a very simple form is basically a thumbs up or a thumbs down. So what RavenPack does is it says, hey, here are all the companies of the S&P 500. What is the news saying about these different companies? So, and it's important to know that it's looking at accredited press articles that are out there to give these companies a sentiment score. Now, many people think that sentiment value is a better predictor in market performance. The more positive press is out there, it could drive, you know, a better performing company than those traditional methods of looking at labor reports, earning reports, things like that. So the RavenPack strategy assigns a sentiment score based upon how many thumbs up or thumbs down these companies have, puts it in to their appropriate sector, and it will pick 4 of these sectors each and every quarter, okay, based upon the best sentiment score there is inside of that sector. Now, it controls the volatility because this is another volatility controlled index with a 5% target volatility by strictly looking at the 2-year treasury and the 10-year treasury. So it goes in and out of the equities and bonds to control that volatility after it has picked those 4 sectors. Now, what's unique about the highlights of RavenPack is this index is not the newest, 2017. Just like Atlas, it can't be illustrated in all states, but it is available for clients to select that on their index annuities. I wish I had more time to go into it, but we have an awesome piece on our agent portal and on our microsite that talks about the points of how the index looks at that sentiment score, calculates that sentiment score, and then picks the appropriate sectors for that quarter. But more importantly, when you see that piece, this index, you're going to say just makes sense. Because when you look back at 2020, when we looked at where the index was actually allocated in, you can say, well, I can totally relate to that index because I did X, Y, and Z. It's no wonder why that index was allocated to those sectors during that quarter. Okay, so it's a great piece. I encourage everybody to look at, but it's an awesome piece to really truly understand the Credit Suisse Raven Pack index. So some more resources. We do a lot of different things at Silac to really kind of help you engage with your clients or even prospect your clients. This is just a screenshot of the microsite. On the top right, when you go to it, it's silacins.com/Silac. Be sure it's all lowercase. That's the main page. On the top right, you're going to see the Silac sites. That's where you can access information not only about our MIGA, our Teton, Denali, Vega, but also our Atlas and our Credit Suisse Raven Pack strategy. You do not need to be appointed to access this information. However, I would encourage you all, if you're not appointed with Silac, to call Dallas or Secure Insurance Group and get appointed, where you can access all of the information on our agent portal. Along with some of those positioning and case studies that I promised you, we have developed a ton of different marketing pieces. So if you're unsure of, hey, what type of client would really fit this? Or, hey, I got this type of client. We have developed all of these different types of case studies for our products. So you can go through them and see how they work, see the key points to really kind of help you talk to your clients about, hey, this is why I think this product works best for you, because you're similar to these types of cases. All right. These are great pieces. They walk you through it. And again, not only do you have Secure Insurance Group for assistance, but you can also call us, call our sales desk, and we can definitely help you out with positioning, getting illustrations, and everything like that out to you that really kind of help your clients. Inside of our sales library, the first piece I want to point at is on your left-hand side. So if any of you have done annuities in the past, we truly believe at Silac an annual review is pretty critical. And if you don't have never done annuities, maybe encourage some existing clients you have to do an annual review and see what type of assets they have. This is a turnkey piece. All you have to do is fill it out, but it uncovers what the client currently has. And you're really doing a checkup to make sure where their assets are currently allocated are in the right place for them to meet their targeted goals later in life. Again, this is a step-by-step process. If you're unsure of how to do it, we actually have a bulleted piece that gives you talking points through the way. Great piece. We love the fact that we developed it because it has Silac on it, in hopes that when we uncover those assets, a Silac product will fit that client, will fit those clients' needs. And of course, our incentive trip. We love to give back to our producers. $5 million of issued premium. Top 60 will get you 2 tickets to an African safari in Tanzania for May 2023. You still have plenty of time to qualify, but we love to give back to our agents that really produce. But Tanzania is going to be an awesome trip. I've seen pictures. I've never been there, but I wanted to point this out. Maybe it kind of gets some people excited on this call, but I wanted to bring that to everybody's attention here today. And with that, I want to say thank you to everybody that attended. I would love to answer any questions that anybody has.